What if I told you that two business owners, both making the exact same income, could end up with tax bills tens of thousands of dollars apart? One writes a massive check to the IRS every April, and the other, well, they're funding their retirement, reinvesting in their business, and keeping significantly more of what they've earned. The difference isn't luck. It isn't some shady loophole. It's strategy. And it's all written there in the tax code. Today, I'm walking you through the exact frameworks that financially savvy business owners use to legally minimize their tax burden. We're covering S-Corp elections, the qualified business income deduction, retirement strategies that can shelter hundreds of thousands of dollars, and a few lesser known tactics that most business owners completely overlook. Stick around to the end because I'm going to show you how one of these strategies can actually cancel out another if you're not paying attention and how to avoid that trap. Let's get into it. All right. Let's start with the big one, the S corporation election. If you're operating as a sole proprietor or a single member LLC, every dollar of profit you earn gets hit with self-employment tax. That's 15.3% right off the top before we even talk about income tax. That S Corp strategy that saves business owners thousands every year, well, here's how it actually works. When you're a sole proprietor, all your profit gets hit with 15.3% self-employment tax. But with an S-Corp election, you split your income into two buckets. Bucket one is your salary. This still gets hit with payroll taxes. Bucket two are distributions, your share of the profits after salary. Now, these distributions are completely free from self-employment tax. So if your business earns $150,000 and you pay yourself a reasonable salary of $80,000, that remaining $70,000 you take as a distribution is not subject to that 15.3% tax. So on that $70,000, that's roughly $10,000 back in your pocket every year. The catch? Your salary has to be reasonable. The IRS isn't going to let you pay yourself $20,000 and take $130,000 in distributions. They're watching. And they've actually deployed AI to flag suspicious salary to distribution ratios. So how do you determine what's reasonable? The IRS looks at factors like what similar roles pay in your industry, the time you devote to the business, your training and your expertise, and even your dividend history. There was a famous court case, Watson v. United States, where a CPA tried paying himself just $24,000 while taking over $200,000 in distributions. At the end of the trial, the court reset his reasonable salary to over $90,000, and he had to pay his attorney's fees. So what should you do? Choose a reasonable salary for yourself based on the factors we just talked about and document your rationale. Keep records of comparable salaries in your market and make sure you're aligned. This is an area where working with a tax professional can pay for itself many times over. Now, S-Corp status doesn't make sense for every business at every stage. The tax savings of this election need to outweigh the additional compliance costs, such as payroll processing, a more complex tax return, and potential state fees. For most business owners, that tipping point hits around $300,000 in revenue or $100,000 in consistent net profit. To make the election, you file a Form 2553 with the IRS, and for 2025, the deadline for calendar year businesses is March 15th. By the way, if you're listening to this and realizing your situation could benefit from this kind of proactive tax planning, that's exactly what we do at Proseer. We work with business owners year-round to build strategies like this into their overall financial picture. If you want to learn more about us and how we work, there's a link in the description below. All right, that's the S-Corp Foundation. The next strategy I'm about to share actually interacts with your S-Corp wages in ways that can help you or hurt you if you don't do it right. Understanding this connection is what separates good tax planning from great tax planning. The qualified business income deduction, also called the QBI deduction or Section 199A. Here's the headline. Eligible business owners can deduct up to 20% of their qualified business income. That's a significant reduction in your taxable income just for running a qualifying business. And here's the big news that was implemented in 2025 and going forward. This deduction is now permanent. It was originally scheduled to expire, which created a couple years of uncertainty. But as of July 2025, that uncertainty is gone. The 20% tax deduction that most business owners don't fully understand, well, it's called the QBI deduction, Section 199A, and it lets eligible business owners deduct up to 20% of their qualified business income. Let's say your business generates $200,000 in qualified income. That potentially equates to a $40,000 deduction, money that never gets taxed. But here's what determines if you qualify. First, your taxable income. For 2025, if you're married filing jointly and under $394,600, you're generally eligible for the full deduction. Single filers, that threshold is $197,300. Second, your industry. Certain fields such as law, accounting, health, consulting, financial services are classified as special service trades. Now, if you're in one of these industries and you're above those income thresholds, well, your deduction phases out completely. But below those thresholds, you get the full 20% regardless of industry. The key is planning, timing your income, maximizing retirement contributions, structuring expenses strategically. These are all things that can keep you under the threshold and preserve your deduction. Now, here's where it connects back to your S-Corp wages. And this is counterintuitive. For business owners above those income thresholds who aren't in a service trade, the QBI deduction gets capped based partly on how much you pay in W-2 wages. The formula allows a deduction up to 50% of the W-2 wages your business pays. So in some situations, paying yourself a higher S-Corp salary, which feels like it should increase your taxes, can actually increase your QBI deduction ceiling. You're balancing payroll tax savings against QBI optimization. This is exactly why tax planning isn't about isolated tactics. It's about understanding how these pieces interact. And that's where having a proactive advisory team can make all the difference. But we'll come back to that. Speaking of pieces interacting, everything we talked about so far reduces your taxable income. What if you could shelter even more while simultaneously building serious wealth for your future? That's where retirement strategies come in, and the numbers I'm about to share genuinely surprise most business owners. Most people think of retirement contributions as capped around $23,500, which is a standard 401k limit for a single employee. But as a business owner, you have access to plans that allow dramatically more. Here's how some business owners can legally shelter over $80,000 per year in retirement accounts. If you're self-employed, forget the $23,500 limit you've heard about. That's for employees. You have access to something much more powerful. The solo 401k lets you contribute in two ways. First, the $23,500 as an employee deferral. Second, an employer profit sharing contribution of up to 25% of your compensation. The combined limit for 2025? $70,000. But here's where it gets even better. If you're between the ages of 60 and 63, there's something called the super catch-up. This adds another $11,250. That brings the potential contribution to over $81,000 in a single year. And for high earners who want to go further, combining a solo 401k with a cash balance plan can shelter $250,000 to $370,000 annually. Every dollar you contribute reduces your taxable income while building tax-deferred wealth. Now, there's a lot more complexity and compliance to implement these strategies, but this is the kind of planning that can change your financial trajectory. So let me give you the landscape here. The solo 401k is ideal for self-employed individuals with no employees other than a spouse. You get that $70,000 combined limit, plus catch-up contributions if you're 50 or older. You can also make Roth contributions and even take loans up to $50,000 from the plan if you need them. Now, the plan needs to be established by December 31st each year to make employee deferrals for that year. SEP IRAs are simpler to administer. No annual IRS filings required, with the same $70,000 maximum. But they lack catch-up contributions and can complicate backdoor Roth strategies. Now, cash balance plans are the advanced move. They're defined benefit plans that require actuarial certification and have mandatory minimum contributions each year. They work best for business owners that have consistent high income, think $280,000 or more, who commit to funding the plan for at least 3 years and are willing to endure the additional compliance. Setup and administration costs run several $1,000s a year annually, but for the right situation, the tax savings can dwarf those costs. All right, we've covered the major frameworks. So here are a few more strategies to have on your radar. An accountable plan. If you have an S-Corp, this is important. An accountable plan allows your business to reimburse you for legitimate business expenses completely tax-free. No income tax, no payroll tax on either side. We're talking mileage, home office costs, travel, professional development, and equipment. The IRS requirements: expenses must have a business connection, and you should document them within 60 days, and you return any excess reimbursement within 120 days. Simple to implement, meaningful savings over time. Let's talk vehicle deductions. The 2025 standard mileage rate is 70 cents per mile. And if you're purchasing a vehicle over 6,000 pounds for legitimate business use, Section 179 deduction limits are significantly more generous than standard passenger vehicles. We're talking potential first-year deductions exceeding $30,000 for qualifying heavy vehicles. Next, self-employment health insurance deduction. If you're paying for health insurance for yourself, your spouse, or dependents, that premium can be deducted above the line. It directly reduces your adjusted gross income, which can help with those QBI thresholds we discussed earlier. Also, a home office deduction. If you have a dedicated space used regularly and exclusively for business, you can deduct either $5 per square foot up to 300 square feet using the simplified method, or calculate your actual expenses for a potentially larger deduction. The common thread? Documentation. Every strategy we've discussed today requires good records. That's not just about compliance, it's about being able to confidently claim what you're entitled to. Here's what I want you to take away. The tax code isn't designed to work against you. It's designed to incentivize certain behaviors. Compensating yourself appropriately, saving for retirement, investing in your business, documenting your expenses. When you understand the rules, you can use them to your advantage. The business owners who keep more of what they earn aren't doing anything exotic. They're just planning proactively instead of scrambling at tax time. And that's really the key word, proactive. These strategies work together. Your entity structure affects your self-employment taxes, your S-Corp wages affect your QBI deduction, your retirement contributions affect your taxable income thresholds. Great tax planning looks at the complete picture year-round, not just in April. If you're at the point where your business and financial situation has real complexity, maybe you're navigating growth, evaluating entity changes, or just tired of feeling like you're leaving money on the table, that's exactly the kind of challenge we built our firm to solve. We take a holistic approach. Accounting, tax, and financial advisory working together with a team that's actually thinking about your situation before you have to ask. If that sounds like what you've been looking for, head to our website, link is in the description, and explore how we work with business owners like you. And if you want to have a real conversation about your specific situation, you can book a consultation right there. Thanks for watching, and go keep more of what you earned.